get started. All right, so this is the third video I'm working on, and what we're going to talk about here are the universal elements of successful trading. All right, so this kind of is a little bit more simplified than the last two subjects. We already spoke about prospect theory, very important to understand that for beginning traders especially. The next subject was on data structure. That's a little more advanced subject, but important to build a base knowledge for what we're trying to do here. And now we're kind of getting down a little bit more to the practical part of it, which is what are the things that we have to do in order to be successful as traders? Like, what are the key elements that have to be in place to do this? Now, I refer to this a lot of times as quote unquote the physics of trading. Now, that's not to suggest that trading is some kind of mathematical certainty. It's not. We've talked about why that trading is a stochastic process, and by their nature, on a trade by trade basis, the outcome leans towards random with a string of order in it. That's our advantage. That's our edge, right? So we have a statistical advantage over a sample size of trades. That's what we're striving to create. So in order to take advantage of that stochastic process, we have to structure our trading correctly in order to capture the things that we want to capture and eliminate the things that we want to eliminate. All right, so that's going to boil down to some of the basic elements of trade structure, which are stops, targets, sizing, and edge. All right. These are, universal rules of the road. Everybody has to obey these same rules. And there's lots of different ways to achieve, to stay within the rules, to achieve the goal. And guys, tweak these a lot, but in general, if you look at what everybody does, successful traders are always using the same elements: risk management, sizing, edge creation, correct targeting. Okay, so these edge components have to be executed correctly. Trading's not hard, but it's not forgiving either. If you don't do all of these elements every time you trade, if you don't make it happen the way that it's supposed to happen, the whole thing falls apart. So it's not like you can do three things right and one thing wrong and it's okay, it's good enough. It doesn't really work that way. You have to do the right things all the time in order to see that statistical advantage expressed at the end of the day. Okay, so stop entry target size. Now, we talked in the last video a lot about kurtotic distributions, or quote unquote fat tails. Fat tails are really important to what we're talking about here. And let me go back to this. This is what a fat tail distribution looks like. This is the way that our data is distributed, the underlying data that we're using, and we talked about that in the last video in data structure. But more importantly to us right now, it's how the results of our trades will be distributed. Okay, so if we do 1,000 trades, how will they be distributed? What we're going to see is that most of the trades are going to fall into the middle of this distribution. They're going to be either small winners or small gainers. That's going to account for something like 86% of our trades, somewhere in that area. And really, essentially, those trades sort of cancel each other out. What we have to worry about, the areas that make a big impact, or the impact on our trading, are in the tails. Those are the outlier trades. Those are the trades that have a much bigger outcome. What we're going to try to do, otherwise we're not going to be successful, is we're going to capture positive outliers. That's the objective. At the same time that we're trying to capture positive outliers, we're trying to eliminate, never experience, in the best case scenario, negative outliers. Right? Large, fat-tailed, negative results we want to eliminate from our trading. while maintaining or capturing positive outliers. Now it's a simple sort of formula. We're trying to capture our big trades. We're trying to eliminate the big losers. Okay, so super important. All right, now how do we do that? How do we eliminate the losers, capture the big winners? First rule, or the first tool that we're going to talk about using is going to be the stop loss. Eliminating that large outlier is the real goal of risk management. So if I go, I'm going to jump forward here real quick. Here's our distribution. Right here, we can see that this is the, let's just say roughly where a stop loss might be, or wherever it might be. But the idea is that it's the use of stop loss or risk management tool in every trade is to eliminate the fat tail loss. All right, that's the whole purpose of it. So a lot of times somebody say, well, why do you use a stop loss so I don't lose money? Yes, really what you're trying to eliminate is the really big loser. That's the problem. The stock that blows up, that really messes up your account. That's the one that we're trying to avoid. On the other side, we have to capture the big outlier gains. Now, that's going to tie down to targeting. One of the most common mistakes I see is bad targeting, especially with traders that are a little more experienced or traders that are trained a little bit or trained. They take their trades off too early and don't capture enough large outlier trades to move the account forward. And we'll talk about that. All right, so here's that stop loss. Now, the reason why most momentum strategies, where we're really trying to capture this large outlier gain, have more losers, because they'll create a negative win-loss ratio. You'll have more losers than you'll have winners. And your brain shouldn't get tied up in win-loss ratios as much. It's only what you make, how much you make versus how much you lose. So if you see a strategy that's got a, as a matter of fact, I just saw somebody's strategy today. They had a 57% win-loss ratio and a 3-to-1 profit factor. Okay, that'll work. That'll work because it's how much you're making. It's the balance between what your win-loss ratio and then how much you make versus how much you lose when you lose. So you got to kind of put that equation together a little bit. I can have any combination of win-loss ratio. I could have a win-loss ratio that's, let's just throw it out there. Let's just say I had a 10% win ratio. I was wrong 90% of the time. It could still work if that 1 out of 10 times that I'm right, I had a huge winner. Let's say every time I had 10 trades or 100 trades, and I lost $10 on every one of those trades that I lost. So 9 out of 10 I lost. That 1 out of 10 or that 10 out of 100, I made $1,000. Well, that's a winning strategy. You made a lot more money than you lost. A really rookie mistake is to get tied up in win-loss ratios. It's totally normal, but your brain is lying to you here. Most new traders want to be right all the time emotionally, and it's got nothing to do with anything. So if we look at this graph right here in front of you, if I had a stop loss, say right about there, and I'm using a momentum to create edge, say a momentum strategy or trend following strategy, I might have 60 out of 100 trades, or 60% of my trades be losers, and only 40% of them be winners. And really, out of the 40% that are winners, only total trades, only about 7 or 8 of them, 7 to 10 of them would really make an impact. Those would be the outlier trades. The impact that would move my account forward. The rest of it would just kind of nullify out to zero. Now, the reason why we have 6 out of 10 trades be losers is because of where the stop loss is. What we're doing is all these trades that would have populated the left side of the distribution all get caught right there at the stop loss. It's like a filter. It just catches them all right there. And all those ones that would have populated, and the key thing here is including the ones that were really big losers, get stopped right at the stop loss. So all my losses are small. That's the number one thing here. All right, so the purpose of the stop loss is to cut off that left side of the distribution. Don't worry about the win-loss ratio as much. Okay, next. Targets. Okay, so this is the other side of the equation. Trading doesn't even work if you're not getting 3-to-1 targets. What happens to guys that take smaller targets? You may see traders that take a lot of 1-to-1s and that kind of stuff, and they're counting on being right. If you take a 1-to-1 target, you're counting on being right more than 50% of the time. To my experience, you're going to create predominantly suboptimal strategies at best. More than likely, what's going to happen to you if you're that kind of trader is if you're taking your trades off too early and you're not capturing any positive outliers in your trading, what's going to happen to you is your equity curve is going to go sideways. We'll talk about this when we talk about diagnostics, and I'm going to do a video on diagnostics to see if you're doing everything the right way. But the most common problem I see is traders don't go for the outlier trade. They take their trades off too early, and they end up with an equity curve that essentially traps them with a bunch of small winners and small losers, and their account really never goes anywhere. And even if they're doing better than 50% win-loss ratio, they're producing a positive equity curve, but it's not what it could have been by a wide margin. So you really want to use a minimum, in my opinion, of 3-to-1 risk-reward ratio. I prefer greater than 5-to-1, and most of the time in my trading, I'm looking for targets that are much larger than that. And so we'll talk a little bit more about strategy later, but we can use other methods like trailing stops and things like that in order to give ourselves a little more leeway in targeting. Okay, so stops, targets. Number 3 is size. I have to do a whole separate video on just this subject because sizing is incredibly important. The key thing to understand about correct position sizing in your trading is that the purpose of it is to survive. Survive long enough to see the math and all this statistical work that we're talking about here pay off, happen. If you don't position size your trades correctly, if you overbet your account, meaning you risk too much per trade, you are going to blow up your account metaphysically. And I'll go through the math later and show you how all that works. But I don't care who you are. It doesn't matter how skilled you are. If you overbet your account, risk too much per trade, and the inflection point seems to be about 2% of your account size, of how much money you have in the account. So if you had $100,000 in the account, if you were risking more than $2,000 per trade, now it doesn't mean the total size of the trade is $2,000. It means from entry to stop loss, how much did I risk is $2,000 or 2% of your overall equity, the money that's yours. You go beyond that and you're going to blow up your account. There's a hockey stick function there. I'll explain kind of the physics of that a little bit, but there's a J-curve, and the inflection point on the J-curve is right at that 2%, and you can see that right here. So if you go out beyond that level, you're definitely going to blow up your account. Now, I typically would never risk 2% of my equity per trade, but I risk more like 0.2, 0.25 per trade. Makes a lot more sense for me. What's going to happen is the more you increase it, the more volatility you're going to get in the account, volatility in your returns. But once that volatility goes past, once you go past 2%, the volatility becomes so great that it guarantees that you clip the account or blow it up. I'll go through that in a separate video. Okay, so far you got to use a stop loss. Have to cut off the left side of the distribution. You have to target correctly, otherwise you can't make any money. It doesn't work. You have to size correctly, right, in order to survive long enough for this whole thing to kind of play out. And the fourth element that's really important here is that you have to create edge. You have to have an advantage, an edge. The two ways that we create edge are mean reversion and trend following. I talked about that in the last video on data structure, but we'll talk about more about it, actually most of these subjects, in another video. Okay, so I'm going to skip all that. Let's talk about this real quick. Trend following characteristics or trend following tactics work with an autoregressive system or a nonlinear cathodically distributed, which is what we have, data set. That's what the markets are. And we talked about in that last video about the spikes, the volatility expansions, and how they help in creating trend. I refer you back to that video, the last video on data structure. Mean reversion works when the data is in noise state. So that's that kind of middle part. If we go back to here, trend following takes advantage of the fat tails. Mean reversion takes advantage of the middle of this distribution, right? Because the data tends to be mean reverting when it's in a noise state. It's in a noise state a lot. So mean reversion tactics tend to work, and there's lots of them: statistical arbitrage, pair trading, etc. Just general mean reversion. But the big trades, the trades that are created in self-reinforcing feedback loops and really can really get going, like really have big moves, those are all happening because of the outlier elements in the data. And that's where the big trades come from. The big outlier winners tend to come from, is really from trend following. And I would characterize, and here's like mean reverting data that would work right here. I would characterize mean reversion trading as having a higher win-loss ratio. You can get a 70, 80% win-loss ratio in mean reversion trading. Good mean reversion tactics, guys, do it. So they're right a lot, but they don't make any money. And the reason is just like you can see in this data right here. It doesn't go anywhere, right? I can guess here that it's going to go back across the range, so I can short it here and cover it down here somewhere. But it really didn't move that far. And I can, play that if I'm good at mean reversion trading. I can play that chop back and forth and come up with different ways and tactics to take advantage of those mean reversion characteristics. But it never really goes anywhere. Whereas if you look over to the right here, a trend following trader might buy it somewhere down here and let it play out for this whole trend. You might be buying it at 20 and letting it go at 40, let's say. Which is 100% return. I mean, it's a you can get some pretty healthy moves. So trend tactics tend to produce those outlier trades. And just think about it, like it'd be like buying Bitcoin at $500 and seeing it go to 60,000, that sort of thing. It's not going to happen with mean reversion trading. Okay, now if we combine all four of those elements, stop loss, targeting, size, and edge, if we combine them all together, this is what we should be. This is what we should have, right? We should create a distribution like this. That's what we want. We cut off the left side of the distribution, capture the big outlier gain. We size correctly, so we allow this to form, and we create edge in our trading so that there will be more outliers. Like the skew of the distribution will be more to the right, towards profit. Bad structure, excuse me, I spelled it wrong. Bad structure is just the opposite. Now, why would people do just the opposite? Well, if you refer back to my video on prospect theory, it explains the psychological driver behind traders creating bad structure. Okay, there's a behavioral finance reason why people do this. Now, what they tend to do, due to prospect theory, is they tend to get out of trades too early. So they get out of the trade too early. The reason is they're afraid of losing money, and they never get a large outlier trade. And then when they have losing trades, they'll hold on to them, and they'll open up the door to allow out of the trades they're holding on that big outlier lose to creep into the equation. Now they do that as well because they're afraid to lose money. They don't want to experience the pain of a loss, so they don't sell it. I'm sure everybody here has done these things. Where, and here's how a trader who's not profiting, who's got a losing strategy overall, here's what they do. They do a trade, it goes against them. They hold on and hope that it comes back to where they bought it. When it doesn't do that, they just hold on to it and it ends up turning into this big ugly loss. I'm sure it's happened to everybody that's listening to the video here at one point or another. What they also do is they've got a trade, it goes up a little bit, and imagine for a second you bought, I'm just going to say something like Bitcoin. You bought it at, I actually knew somebody that bought it at $100. They sold it at 120. 20% gain, right? Thing ended up going to, and they had a lot of it, ended up going to 60,000. They didn't buy it back because, you know, they had already let it go and they just emotionally couldn't buy it back when it took off, which is also very common. But the story there was they bought it, and as soon as it went up a little bit, went in their direction, made them a little bit of money, they sold it, and then it really took off. Okay, so they never got the big outlier gain. But, and this is very common, a lot of traders don't get big outlier gains and they end up experiencing big outlier losers. A winning trader position sizes their trades. They don't risk too much in any one trade. When the trade goes against them, they've got a set stop, real quick stop loss, they're out of the trade. So no large loss can sneak into the equation. And it doesn't matter if I'm wrong more than I'm right, as long as all those losses are small. But when I have a winner, I let it work. I let it go off to a much larger target than another trader might expect. 5 to 1, 10 to 1, 20 to 1, you know, plus. All right? That's the equation. Now, here's how it looks, that equation looks when you see it actually play out here. Here's that winning trader. So most of their trades are going to be small wins and small losses. Totally normal. Every once in a while, 1 out of 10 times, about 1 out of 10 times, 7 to 10%, they're going to land on a big winner. That pushes the account forward. There's your big move. Then it goes back to small winners, small losers. Then I hit another winner, back to small winners, small losers, hit another winner. And say there's 30 trades here. I might have only had 3 outlier trades, those fat tail trades that I'm looking for, but that's where all the movement in the account came from. It's very typical. So that's a trader that's producing a positive winning equity curve. Now, the trader, that's this trader here. The trader that's doing this, which is most new traders, probably 90% of brand new traders, their distribution of gains on winning trades and losing trades looks like this. What they're doing is they've got small winners and small losers, but anytime there was a big winner that was involved that they landed on, say it was Bitcoin or say it was Tesla or Nvidia or something like that, as soon as it went up a little bit, they sold it. So, because they didn't want to lose. They didn't want to fall back against them and go back down the other way. So they never got the benefit of seeing that gain. No big outlier. But when they hit a loser, they tended to hold on to it because they didn't want to experience the pain of a loss. So they held on to it. And every once in a while, one of those ones they hold on to doesn't come back because, you know, the idea is I'll hold on to it. It comes back to where I bought it. Maybe I'll get out of it. They held on to it. It just kept going down. And that produced a big outlier loss. So the impulse is now in their equity curve is to the downside. So it's small winner, small loss, downside, small winner, small loss, downside. So it's the same exact thing completely in reverse. So just like this is in reverse, here's what we want. Most people do the exact opposite of that. If we look at the equity curves, they are created exactly in reverse. Right? This is the winning trader. This is the losing trader. Okay, so it's pretty simple to understand. It's really hard to do. That's the psychological part of it. That's the behavioral finance part of it. That's why I'm always talking about prospect theory for new traders. You got to master that. Otherwise, it's the delineation point between success and failure. Okay, so we have to do these basic tasks on every single trade. I'll save that casino analogy for later. This is the prospect theory stuff. Okay, so let's talk about this. You know, the elements of the trades are always present. Stop loss, entry, target, size. They have to be executed correctly. Failure to do so is a losing strategy. It's just not going to work for you. There's no way around it. It's I don't care how smart you are. All right, so you have to obey what the data structure dictates, and this is what it dictates. Okay, so if you follow those elements, you will have a winning strategy. Now, I will say this, guys. I've taught a lot of people I've taught a lot of classes, I've taught a lot of people about trading. And what I see a lot is people, when they leave a class, they would be very, pumped up. They understand, they understand what we're trying to teach them. They're excited to do it, and they go out and they execute the plan correctly, and they get a great result. But inevitably, you slip back into the habits, and that's the psychological part of it sneaking in, and they start doing, they get off what they're supposed to do. So here's this map, this blueprint that tells you how to do it, and everybody, tends to get off the path. The traders that ultimately become successful is because they got back on the path. So, there's a lot of obstacles in executing this plan, but it's a simple plan. You're, predominantly going to be the problem. Your psychology is going to be the problem, and that will dictate your success or failure. Trading's not hard to understand. It's not. It's just hard to do. Okay, guys, I'm going to stop right there, and I'll make another video soon.